Our federal election is heating up with incentives and tax cuts and a lot more. My friends, we're going to talk about this and helping Canadians save a tremendous amount of money on their mortgages. All this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
I'm great, man. I'm happy to share today some methods we're using to help people save a ton of interest on their mortgages.
Saving money, like no Canadian ever wanted to hear that. That is music to most.
World, yeah.
That's right. That's right. We got a few things we're going to talk about. Saving money, of course, how the interest rates are always affecting your choices and in the different products that are out there. But we should probably kind of talk about the big elephant in the room just ever so slightly. We're recording this April 2nd, so this is not April Fool's. And of course, the hot topics are, our political climate here in Canada as we go through this next election, and everything that the Canadian election really is being influenced as well from our not so brotherly neighbor from the south at the moment. And of course, that has effect on many things. So one of the things, Dion, that not only tariffs, but maybe more importantly, the dollar, the Canadian dollar versus the US dollar, as we all know, this is not news. This is not new news, I should say. Canadians are choosing not to vacation into the States.
Yeah,
right?
And I mean, that's to be expected given the sentiment alone. But on top of that, the economic factor of, lower Canadian dollar value, right?
Yeah. And here's what I'm starting to see and hear from my friends and colleagues, and even in the news, of those that own, maybe cottages or Airbnbs in cottage country, if you will, the vacation type second properties. That strange ripple effect, Dion, from Canadians choosing not to vacation into the States is almost all those summer bookings for cottages and vacation homes are almost all booked up.
Yeah, and it's great to see, because you and I have spoken about the weaker cottage market and the fact that during COVID, many people moved to cottage country. Now, because they're called back to the office, they're now moving back into the core of the GTA, which has left that sort of cottage market a little bit soft. But if that softness can be helped with extra bookings at probably higher than standard rates as well, it's going to help those cottage owners significantly.
Yeah, it's, everything has a ripple effect, and this is one of those ripple effects. And like I said, people are choosing to vacation locally, if you will, locally being Canada in this reference. And hey, this might not be your experience. Granted that I understand that. However, everything that I'm seeing and reading and hearing from my friends and colleagues, as I mentioned, is that they're booking right up through to the end of summer now, and that is that interesting ripple effect. Everything gets adjusted when we start talking about the economy and making big policy changes and things like that. And I know both. I always say both parties. I get it. There's more than two parties in Canada, but the leading two parties are, they have big ideas what they want to do if they are in power over the next 4 or 5 years. And keep your ear to the ground, because there's things coming out every day that has, great incentives, but there's always pros and cons to everything. So every time you read a tax cut, which is awesome, just have that understanding. If there's a tax cut, that's less income coming into the government, which some would say is a good thing. But we all know our budget's here and our income's here. So just have that in mind when we hear about all these great things, right?
Or are you in particular talking about the no capital gains tax on investment property?
Well, that could be one of them, which is
right.
I think a really, really cool feature, because as we all know, in the States, you've been able to do that for many, many years. Is to in a sense, we're deferring that tax, but we're rolling it over, right?
Yeah, exactly. So for those who aren't aware, in the United States, let's say you buy a property for $100,000 and you sell it for $150,000, you have a $50,000 capital gain. in the United States, as long as you buy a similar or better property. So let's say you buy a property for $200,000, that $50,000 gain will not be taxed because it's being utilized in the acquisition of a similar or better property. And if they were to do this, let's say, imagine they did this every year for 10 years, you'll roll a 50 grand gain up to $1 million gain without having to incur any taxes. So a lot of Canadians have actually turned to the United States in the last couple of years, started investing there, and that's one of the very reasons that they're doing it. And so the opposition leader right now has proposed a similar U.S.-style capital gains tax deferral on his platform, which frankly will be attractive to a lot of property owners.
Yeah, it's definitely interesting, and one that you need to read through and understand. And really, it's just like, I shouldn't say just like it. It's similar to your RSP contributions in a sense. From this perspective, I think is RSP contributions is really, we're deferring our taxes to down the road, and that's
yes,
kind of
correct.
what this is in a sense. However, this will, in my opinion, whether you're for it or not, from my perspective, Dion, is this will actually stimulate, and I use that word cautiously, the real estate market, because what we'll see is decisions to, no, I can sell this property because I'm not going to pay capital gains on it because I'm going to go out and buy another property with those funds. So it'll be a small segment of that, and we'll see a little stimulation there if that gets brought in by any party going forward.
Yeah, and I mean, you raise a good point in that it's depriving the government of some form of tax, which is, to be utilized in the economy. But on the flip side, it might create more economic activity with, real estate transactions and renovations and construction and those types of things. I'd be interested to see a case study as to, the loss in taxes, but the benefit in, economic activity, and see if there is, in fact, a net benefit. My guess is there probably would be.
Yeah, it's a good point. We've said on the show here many times before, definitely in the GTA area, in the Toronto area, and this would be similar to Vancouver because the prices are about the same. In those areas, typically when a home is sold, it stimulates approximately $60,000 into the local economy.
And everybody who transacts at that time also pays taxes, income taxes, HST, GST. So, yeah, maybe those taxes will be regained in that form.
Yeah, that's an interesting perspective. Like we said, every decision has a ripple effect, and just understanding what those ripples are, and maybe there's opportunities on some of those ripples for our listeners as well, and just knowing how to understand it and how to read it. Okay. Something that we don't often talk about, Dion, is construction and construction mortgages, and we've all done some sort of renovations or construction projects in the past. Talk to us a little bit about construction mortgages and what you can do there.
Yeah, so interesting. We just were talking about cottages. Just yesterday, we closed on a construction loan for a family who are building that cottage that they wanted. So I'll just explain to you how construction loans work. The lenders who lend money for you to build a cottage or a house or whatever it might be, they are lending you based on the projected future value of that asset. So an asset that does not yet exist. So the first thing I want to say is people who take on construction loans have to understand that that lender is taking on a greater risk. Therefore, the interest rates associated with construction loans are quite a bit higher than the loans that are associated with a regular mortgage on a regular house that exists in a regular neighborhood, because they're lending based on the future projected value. And also, that lender takes on the risk that if, for whatever reason, the borrowers don't properly execute on the construction loan lender actually has to step in and project manage that construction all the way to the finish line. So when borrowing construction loan money, first things to know, it's going to cost you more than a standard mortgage. The second thing that you should know is that the loan to value, the amount of money that they're going to lend you, will also be quite a bit lower. As you probably know, a conventional mortgage will allow you to borrow 80% of the property's value. With a construction loan, for the most part, you're going to cap out at probably 65%. So I'll give you an example. Let's say that the piece of land you purchased is $200,000. and the cost to build the property is $400,000. So we have a total $600,000 cost. But let's say the projections are such that the property, when completed, will be worth $1 million based on the surrounding sales. So we've got an end value of $1 million. We've got a required construction loan of, say, $600,000. And a lender will lend you 65%, which would technically be $650,000. So in this very simple example I'm giving you, the cost of this entire construction would be funded by the construction loan lender. In most cases, there's going to be some capital requirement from the actual borrower themselves. Maybe they bought the land cash themselves. So there's probably still some cash requirement. But at the end of the day, if we can get you a loan for 65%, for the most part, that helps most people. And why would people choose to build rather than just buy existing? Well, a couple of reasons. Number one, you get exactly what you want rather than buying somebody else's dream home. And secondly, there's oftentimes significant savings. If you can manage that project well, you might end up producing that asset that cost you, say, $600,000, but it's actually worth $1 million. And we've seen some very good stories where people were able to do that.
I think it's an untapped market in the sense that, obviously your everyday buyer is not going to be going down that road. However, you and I we don't always talk to everyday buyers. And that's why having this type of knowledge and input is incredibly important to have on your team. It's similar to when we would talk about when we would take our investors out shopping and we couldn't find the duplex or the triplex or what have you. So we go buy a single family home that can be converted. It's kind of a similar storyline to that. If we can't go find and purchase what we want, well, let's go create it, right?
Correct. And in fact, I've got another client right now who's buying that single family home that can get that duplex basement apartment in, and it has a 3-car garage. And so they're looking at converting that into an accessory dwelling unit as well. So turning 1 into 3. And again, we'd be looking at a construction loan for something like that as well.
I love it. We haven't said this in a while, so I'll say it now. The 3 questions you should ask yourself every time you're buying a home is, how are you going to buy it? Meaning, talk to Dion. Where are the funds coming from? And in this case, how can you add value to it? And that's exactly what we're talking about here, right? Income streams or converting the home or, whatever that looks like. And then the third one, most importantly, which we should never forget because we always do, is how are we going to sell it? Is this something, is this in an area that people will want down the road? Or life changes, as we all know. Is it something that you can exit somewhat easily compared to something way out in the boonies or that type of thing, right?
Yeah, look, and in my opinion, now more than ever, that second or third unit that produces that mortgage helper income through rental is going to be ever more important in the years ahead.
Excellent. Okay. We love helping people save money. And that just Canadians' ears perk up when we talk about saving money. I'm going to share the screen here, but before I do that, why don't you set it up and then you lead me and I'll flip up the slides that you want to talk to.
Sure. So as everybody is probably very aware, in the years 22 and 23 and 24, interest rates were sky high. And many people had to renew during that 3-year window where interest rates were in excess of 6 and sometimes 7% interest rates. And not knowing what the future held, a lot of people chose a middle-of-the-road mortgage term. The 3-year mortgage was very popular over the last couple of years. Now what we have, though, is we have a lot of people who locked in to a fixed interest rate for 3 years. They might have maybe 1 or 2 years ahead of them, and they feel like they're just going to have to, hold on to that rate for the remainder of their term. But we've been running some numbers, and we've been helping a lot of clients look at possibly breaking that high interest rate, paying the penalty, and still saving by going into a much lower interest rate. So I sent over some graphics for you, Gary. Let's pull those up now. So here's a situation where we've got a client, and we'll look at that left box first, which is the current mortgage is $550, interest rates $679, and that monthly payments over $3,600. And on the right-hand side there, what we have is that mortgage refinance. So you'll notice that the mortgage balance is about $11,000 higher, because we rolled the penalty to break that mortgage into the new mortgage. So let's be clear, we've gone backwards about 11 grand. But when you look at that interest rate, we've dropped by more than 2% there. And that monthly payment has dropped by nearly $1,000 there. So that's the situation that we put one of our clients into recently through our brokerage. Just go on to that next slide. Let's also just sort of demonstrate these savings. So in terms of the interest rate comparison or the interest saved, okay, on the left-hand side, in the middle there, we have the current path that the client is on. They're going to pay over $54,000 in interest. In the proposed new path, even with the penalty rolled in, they're going to only pay $46,000 approximately in interest. So the total saving in interest for this client is over $8,000. So that was just, and by the way, this is like, we're talking about an hour and a half of paperwork. Okay. So Gary, for an hour and a half of paperwork, would you want to do an hour and a half of paperwork in order to save $8,000? I think the answer is yes every day, right? And this is a middle of the road saving. We have saved people more. We've saved people less. But even if it was a saving of $1,000, is that still worth an hour and a half of your time? If you're not making $800 an hour, then an hour and a half of your time spent on refinancing is still worth it for most people. Okay, yeah, you want to jump onto that next slide?
Yeah, absolutely. Let's do it.
So we talked about that payment saving. So over that same period of time, and we have about 18 months left on this particular mortgage, we saved this client nearly $10,000 in payments, okay? Mm-hmm. So on a monthly basis, if you added all that up over the remaining term, they would have around $9,800 extra cash in their bank account. And the cool thing is, if they really wanted to, they could take that extra payment and pay it into their mortgage, therefore paying off their mortgage even faster if they wanted to, okay? And we'll jump onto that very last one. So in summary, we saved the client around $8,200 in interest, as well as $9,800 in actual payments. So these are the savings that are actually available to anybody right now. The sweet spot right now seems to be if your interest rate is above 5.6%, then we should probably talk, because we will save you money.
That's the important question that I wanted to highlight and bring up, is at what point should we be having this conversation? So at about that 5.6 you're suggesting.
Right. Yeah, that's where the sort of the numbers break even or get better. And so even if all we ended up doing was saving you cash flow, let's say the interest saving was zero, but the cash flow saving was $300, $400, $500 a month. For many people, that extra $500 breathing room is significant.
Absolutely. And we've all seen, everything's kind of gone up in price, whether it's, groceries or what have you. That is an important savings. That's, that can mean, another $36,000 to $4,000 a month. Or sorry, a month. I wish a year. But that could, that does a lot. That's a vacation for some. That's a lot of cash flow that you can have access to by knowing some of this information and by reaching out to Dion and his team to having this kind of conversation. Dion, this is always important. We maybe don't talk about this enough, but to sit back and kind of have a true understanding of your own personal finances, really on a monthly basis, but definitely on a quarterly basis. Is this still the right mortgage for us? Reaching out to your team to make sure, nothing's changed, but maybe next quarter we'll see a difference in something, right? Where maybe refinancing doesn't always mean taking money out of the bank and getting access to it. It means, in this scenario, having a better mortgage product working for you in a sense, whether it's lower interest rates or what have you, right?
Correct, yeah. And in that example, we kept the amortization exactly the same. So we're not necessarily stretching out an amortization if you want to keep it where it is. And yeah, if at the end of the day we can save you, let's just say it's that $500 a month, $6,000 a year. Just for context, that's $6,000 in savings is after tax. Okay, and what I mean by that is, if you were in order to save $6,000 in your bank account this year, you probably have to go to work and earn $9,000 to $11,000, right? So it's like getting a $10,000 pay increase this year by saving $6,000 in cash flow just through a refinance.
Excellent, excellent stuff. Okay, my friend, how do people get a hold of you to have this type of conversation?
Yeah, so kangamortgage.ca or Instagram at the Dion Beg. What I shared with you today, Gary, are actual reports that we will customize for each individual client. And so if you want to know, like down to the penny, what is the impact of this decision, we can actually give you that report.
There you have it, my friends. That's the Dion Beg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.